All right, ready to dive into something pretty interesting today. We're tackling market-neutral carry strategies. That kind of investing where you try to make money without being totally dependent on the market going up.
Yeah. It's a strategy that a lot of people are curious about. And this JP Morgan paper we're looking at, it really breaks it all down.
Feels like we're getting a peek behind the curtain of what like hedge funds and stuff are doing.
Right.
But before we get too deep into it, let's just break down what carry even means when we're talking about investing.
Okay, so at its most basic level, carry is the return you get just for holding an asset, even if the price of that asset doesn't change.
Okay, so it's not about buying low and selling high. It's more about just owning something that kind of pays you to own it.
Exactly. It's like a built-in reward for being patient.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
And that reward, it can come from a bunch of different places depending on what you're holding. The paper gives some examples.
Okay, like what?
Well, let's say you're looking at currencies.
Currencies, okay. So I'm guessing interest rates are involved somehow?
You got it. Imagine you borrow money in one currency with a really low interest rate, like the Japanese yen. Then you take that money and invest it in a different currency with a much higher interest rate, like maybe the Australian dollar. The difference in those two interest rates, that's your carry.
So you're basically making money off the difference in interest rates. Interesting.
Yeah, it's like the market is paying you to hold that Australian dollar.
I like it. So that's with currencies, but this idea of carry, it applies to other assets too.
Right, like bonds. With bonds, carry is not just the interest payments you get. It also comes from something called roll down.
Roll down. Okay, now I'm intrigued.
Basically, as a bond gets closer to its maturity date, its price naturally moves towards its face value.
Okay.
If you buy a bond at a discount and the yield curve is upward sloping, meaning longer-term bonds have higher yields, you get this roll-down effect. It's like your bond is rolling down a hill, getting closer to its final destination, and you get to keep the difference.
I like that visual, the bond rolling downhill. Okay, so we've got carry with currencies, we've got carry with bonds. What about something more, I don't know, exotic, like credit or commodities?
Oh, yeah. Those are great examples because they really show how diverse carry can be. In credit markets, one way to get carry is by selling credit protection. It's kind of like being an insurance company.
Okay.
You're betting that a borrower won't default on their debt. If they don't, you get to keep the premium you charge for that protection. That premium, that's your carry.
Oh, that's a risky game, though.
It can be. But that's why sophisticated investors use all sorts of tools to manage that risk.
Okay, and commodities. Commodities are like notoriously volatile. How do you even find carry there?
Well, commodities, that's where things get really interesting. A lot of it comes down to what's called convenience yield.
Convenience yield. I'm not familiar with that one.
Think about it like this. There's a benefit to physically holding a commodity, even if you're not using it right now. Like, imagine a company that needs a constant supply of copper. They're willing to pay extra to have that copper sitting in their warehouse, just in case.
So it's like peace of mind, knowing you've got that commodity ready to go.
Right, and that's what convenience yield is. And that willingness to pay a premium, it can actually create price differences between futures contracts. And those differences are where the carry opportunities are.
Okay, I'm starting to see how this all fits together. Currencies, bonds, credit, even commodities. They all offer these ways to get carry. But the name of the game here is market-neutral carry strategies. What's the catch? Why not just load up on the highest carry stuff and call it a day?
Well, that's the thing. Those traditional carry strategies, the ones where you just chase the highest yields, they have a big weakness. They're vulnerable to sudden changes in the market.
Ah, okay. So what happens?
Well, imagine a calm, predictable market. Those strategies, they do pretty well. But when fear and uncertainty hit the market, things can go south really fast.
Makes sense, yeah.
The assets that offer the highest carry, they're often seen as the riskiest. So when investors get nervous, they tend to dump those assets first. And that can lead to some pretty big losses.
So it's not just free money then?
No, not at all.
Uh-huh.
And that's where this idea of market neutral comes in. The goal is to capture that carry, that rental income, but without being exposed to those big swings in the market.
Sounds like a magic trick. How do you do that?
It gets a little complicated. So now let's get into how these market neutral carry strategies actually work, in different markets.
Yeah. I'm especially curious about currencies, because you mentioned how like a market neutral approach with currencies, it can sometimes lead to some unexpected trades, right? Like something's going along the Japanese yen, which seems kind of counterintuitive since it's usually a low yielding currency.
Yeah, that's a good point. It kind of highlights the difference between just chasing yield and really thinking about how carry and risk work together. Like in a traditional FX carry trade, you'd usually be short in yen, but with market neutral, it's more about looking at the bigger picture. We talked about those major things that drive the market, like interest rate changes and economic growth and investor sentiment. A market neutral strategy, it tries to figure out how each currency is going to move based on all those factors, not just its interest rate.
So you're not just looking at one piece of the puzzle. You're trying to see the whole picture.
Exactly. And with the yen specifically, yeah, it has low interest rates, but it's also seen as a safe haven. So when things get uncertain in the global economy, investors, they tend to flock to the yen.
Oh, I see. So even though it doesn't pay much in interest, it can go up in value when people are scared.
Right. So that kind of acts like a different kind of carry.
Interesting. So a market neutral strategy, it might actually buy the yen if it thinks the market's about to get shaky.
Exactly. Because it's not just about the interest rate, it's about all those other factors too.
So you're not just blindly chasing the highest yield. You're trying to be smart about it. Okay, so that's currencies. What about something like the rates roll down strategy?
Yeah, so with rates roll down, a traditional approach is all about taking advantage of the shape of the yield curve.
Right. Buying bonds when the curve is steep and then selling them when it flattens, trying to ride that wave.
Right. But a market neutral approach, it goes a step further. It tries to get rid of the impact of those big interest rate movements that happen because of things like, central bank decisions or inflation expectation.
So it's not just riding the tide. It's trying to find these little currents within the tide.
Yeah, that's a good way to put it. And to do that, investors use all sorts of tools like interest rate swaps and other derivatives. It gets pretty complex.
Sounds like it. All right, let's shift gears to the credit markets. From what I've read, market-neutral credit carry strategies, they seem to involve some pretty complicated stuff.
Yeah, they definitely can.
I'm particularly curious about those, what were they called, credit default swaps?
Yeah, credit default swaps or CDS, they're basically like insurance on bonds.
Okay.
So if the bond issuer can't pay their debt, the person who sold the CDS has to pay the buyer.
Okay.
And in a market-neutral credit carry strategy, these CDS, they become really important tools for managing risk.
So it's like you're setting up your own little insurance marketplace, right? You're buying and selling protection on different bonds, trying to find the right balance.
Exactly. Like you might sell CDS protection on a company that you think is really solid. You're basically betting they won't default. But at the same time, you might buy protection on a company that seems riskier.
Okay, so you're not just betting on whether the whole credit market is going to do well or not.
Right. It's more nuanced than that.
You're looking at specific companies and making these sort of side bets.
Exactly. And what drives the performance of these strategies, it's not just about whether a single company defaults. The paper, it talks about how things like liquidity in the CDS market and the shape of the credit curve and even the correlation between different credit instruments, those things all matter.
Okay, wow, that's a lot to consider. All right, let's move on to commodities. They always seem to be in a world of their own. We talked about convenience yield last time. How does that fit into a market-neutral commodity carry strategy?
Convenience yield. Yeah, that's a big one when it comes to commodities. It's all about that benefit of physically holding the commodity, even if you don't need to use it right away.
Right, like having that copper in your warehouse just in case.
Exactly. And those differences in convenience yield, they can create carry opportunities. Remember how we talked about how commodity futures curves, they're not always these straight lines?
Yeah, they can get all curvy and unpredictable.
Right. Well, those curves, they tell us a lot about what the market thinks is going to happen with supply and demand in the future. And that affects convenience yields and, carry opportunities.
So if curve is really steep, that might mean there's a high convenience yield.
It could. But a market-neutral approach, it doesn't just look at those curves with the naked eye. It uses models to analyze them, to try to find mispricings, and to hedge against those big price swings that commodities are known for.
So you're not just betting on whether oil prices are going to go up or down. You're doing something more sophisticated.
Exactly. You're looking for those little inefficiencies in the market, places where the convenience yield might be mispriced.
Interesting. Okay, last but not least, let's talk about equity index futures. Those are already pretty complicated. But how do you even apply market neutral carry to them, especially with dividends and all that?
Yeah, with equity index futures, it gets really intricate. The research paper, it talks about two main approaches. One is all about strategically capturing those dividends.
So you're basically buying the futures right before the dividend is paid and then selling right after, trying to pocket that dividend.
That's the basic idea. But you also have to hedge against those potential price changes in the index itself. And dividends, they can be kind of unpredictable, so you have to be good at predicting what the market thinks those dividends are going to be.
That sounds tricky. What about the other approach?
The other approach, it's more about modeling the total return of the index. Taking into account interest rates, dividends, and how much the index is expected to grow.
So you're looking at the whole package, not just the dividends.
Right. And by hedging against those big market movements, you can try to isolate the pure carry component of that total return.
Okay, so both of these approaches with equity index futures, they sound really sophisticated.
Yeah, they require a lot of modeling and understanding how the market works.
Okay, so we've covered a lot of ground here. Currencies, bonds, credit, commodities, even equity index futures. It seems like the common thread is that market-neutral carry strategies are all about using these complex models and hedging techniques.
Exactly. It's about filtering out the noise in the market and finding that pure carry signal.
And protecting yourself from those big market swings.
Right, so you can sleep at night.
Well said. I may not be building my own market-neutral carry portfolio anytime soon, but I definitely feel like I have a better understanding of how it all works.
Good. That's the goal.
All right, well, in the final part of this deep dive, I'm excited to find out what the JP Morgan researchers actually found when they tested all of these strategies. Did they actually work?
Yeah, I think we're all ready to see the results.
Okay, so we've talked about what carry is, how you try to make it market neutral, and all the different ways you can do that in different markets. But now, the big question, does it actually work?
Right, the moment of truth. Well, the JP Morgan paper, they actually tested all these strategies using decades of real market data, and the results are pretty interesting.
Okay, so tell me, did they find that holy grail, consistent returns without all the risk?
Well, they found that the combined portfolio of all these market-neutral carry strategies, it did give positive returns pretty consistently and with a lot less volatility than just, chasing the highest yield.
So they were actually getting that rental income without those huge drops when the market freaks out.
Exactly. And the data shows that if you diversify, spread your bets across different asset classes, you can really smooth out those returns and make your portfolio a lot less risky overall.
That makes sense. Don't put all your eggs in one basket.
Yeah, right. And that's especially important with carry strategies because they can be sensitive to sudden changes in sentiment, when people get scared and dump those riskier assets.
Yeah, like when everyone's running for the exits at the same time.
Exactly. So a diversified market-neutral carry portfolio, it can help you ride out those storms.
Okay, so diversification is key. Got it. But what about those other ideas we talked about, like yield rotation and trend following? Did they look into those?
Yeah, they did. And they found that yield rotation, always shifting to the assets with the highest carry, it could boost returns, but it also made the portfolio a little riskier.
So more reward, but also more risk. Classic trade-off.
Exactly. They basically said that yield rotation, it can be a good tool, but you got to use it carefully, maybe as an extra layer on top of your core market-neutral carry portfolio.
Okay, that makes sense. Don't want to get too greedy.
Yeah.
What about trend following? Any benefit to combining that with market-neutral carry?
This is where it gets really interesting. Because trend following is all about riding those big market waves. And market-neutral carry, it's more about consistency when things are calm.
So they kind of do different things.
Right. And what they found was that if you combine them, you get a portfolio that works pretty well in a lot of different market environments. They kind of complement each other.
So you get that steady carry return when things are quiet.
Yeah.
But you also have that trend following engine ready to go if the market takes off.
Exactly. And their analysis showed that this combo, it was especially good during those really rough times like the financial crisis, when carry strategies struggled, but trend following did really well.
Oh, wow. That's pretty powerful.
Yeah, it's like having a backup system.
Okay, so yeah, these strategies, they're definitely complicated.
Yeah, they're not for everyone.
But I think the main takeaway for any investor is to really understand risk and how to manage it.
Right. Absolutely. These market-neutral carry strategies, they're a great example of how the pros are trying to achieve those consistent returns without all the stress of the market going up and down all the time.
Yeah. Makes you appreciate how much work goes into it, all the thought and modeling and research.
For sure.
Well, I think we've covered pretty much everything from this paper. We've looked at what market-neutral carry is, why it matters, and how it works in practice. And I feel like I have a much better understanding of it all now.
That's great to hear.
Well, thanks for joining me on this deep dive. I hope our listeners enjoyed it as much as I did. It's been a fascinating journey into the world of quantitative finance and, the constant search for those elusive, consistent, risk-adjusted returns.
Yeah, it's always an adventure. There's always something new to learn.
Exactly. That's what keeps it interesting. So until next time, stay curious and happy investing, everyone.